Are you buying the wrong dividend stock? We have the Coca-Cola company, ticker symbol KO, down 7% over the last 12 months. In comparison, we have Coca-Cola Consolidated, ticker symbol COKE, up 57% over the last 12 months. Now today is going to be an educational video about why you shouldn't always look at the long list of stocks that are always regurgitated by investors and look and think outside the box. We're going to compare both of these companies. We're going to look at Coca-Cola, take a look at some of their metrics, their dividend safety, do the same information for Coca-Cola Incorporated, and do a deep dive of this company, which has performed very well over the last 10 years. In fact, over the last 10 years, like for like, we see COKE outperform significantly, 991% versus Coca-Cola at 97%. We'll take a lot more look and detail within this to understand where this is coming from, as well as whether or not this is one we should consider in the future. We'll also take a look at Coca-Cola Consolidated, a bit of an in-depth look at their top line revenue, as well as bottom line net income growth, and have a quick look at the health of the company, their total cash versus their total debt. And as always, we're going to put both companies in the valuation model to get to both of their intrinsic value, see which one has a better margin of safety and which one has higher upside in comparison to what Wall Street are forecasting for the next 12 months. Now, before we start any number analysis, what we want to do is just let you know what these companies do if it's the first time you're hearing it. Coca-Cola Consolidated are in fact the largest Coca-Cola bottler in the US and have been for the last 121 years. Now, the way this company operates, they essentially make, sell, and distribute beverages of the Coca-Cola company, ticker symbol KO, and other partner companies. So when we take a look at the Coca-Cola system, the way it works is that the Coca-Cola company will effectively generate revenues. They'll sell the concentrates and the syrups to their bottling partners like Coca-Cola Consolidated. And then, as we can see here, these bottling partners will combine the syrups, the concentrates with still or sparkling water, and then they will prepare, package, and sell and distribute the final products, as we can see here. So a little bit of the history of these companies. Now, when we take a look at the company, so the Coca-Cola company, it is down 7% over the last 12 months. And over the last 10 years, it is up 43%, right now trading in the midpoint of the 52-week range, and it does have a yield of 3.3%, and we note the forward PE just below 21. In comparison, when we take a look at Coca-Cola Consolidated, it is up over the last 12 months, over 56%, and over the last 10 years, significantly outperforming Coca-Cola, up 937%. It does trade in the mid to upper end of the 52-week range, and yes, it does have a forward yield that is smaller in comparison, but when you factor in total return over the last 10 years, it does look like historically the better stock to have held. And we do see it, in fact, on a P trailing 12 months basis at 1879. One thing we do want to point out with Coca-Cola Consolidated is even though the yield is very small, very, very similar to Costco Corporation, they do, in fact, also do special dividends, with the latest one, in fact, being December last year, and this equivalated to $16 per share. So it was quite a significant amount. Now, when we analyze the business very briefly, what we can see on their top line, they have increasing revenues, $1.7 billion in December 2014, $6.7 billion in their latest annual accounts. So they are growing over the last 10 years, as we can see here. So that is a positive sign of this business. And when we take a look at their bottom line net income, we also see a very similar story. 31 million reported in net profit in 2014, 408 million in December 2023. So top line is increasing, bottom line is also increasing, and we can see over the longer term, whilst we do note some inconsistencies, it is again moving in the right direction. A quick look at the health of this company, their total cash versus total debt. Well, their cash has increased dramatically from 9 million in December 2014 to 635 in their latest annual account. And we can see, again, inconsistent nonetheless, has been growing over the longer term. Their total debt has gone up from 504 million in December 2014 to 735. And as we can see here, their total debt, whilst has increased over the period, has also decreased from the highs of December 2019. Now, in terms of institutional ownership, it does sit around 48%. We see 319 million worth of sales by the institutions, but we see more than 3 times buys over 1 billion during the same period, with the largest of these, as we can clearly see, in quarter 4 of 2023, 733 million buys versus 108 million worth of sales. Now, very quickly, we do want to let you know we have released our latest free weekly article where we do run through 10 stocks with significant upside, all completely free. If you want to gain access to any of these articles, do click on the pinned comment below and you can get instant access and start reading. Now, before we jump into the metrics, just to go through this again, so if we look over the last year, now bear in mind this is total return, so it does include those dividends reinvested, and we do understand that KO does have a higher yield than COKE. We see COKE up 57% over the last 12 months. Over the last 5 years, up 193%, significantly outperforming KO. And when we extend it over the last 10 years, as we ran through earlier, significant outperformance. Now, one thing we will mention, just because the share price in comparison is sitting a lot higher than Coca-Cola Company, it doesn't mean anything in terms of investing. You can buy fractional shares if this is a company you do want to consider or invest in. So do not let that make any influence on your decision. So let's take a very quick look at the two companies. We have Coca-Cola with a dividend safety score of 80, indicating safe. Market cap 251 billion. It is a mega cap company. In comparison, we have Coca-Cola Consolidated. While we don't have a dividend safety score, it is a much smaller company. Market cap of 7.66 billion, a mid cap company. In terms of dividend growth with Coca-Cola, we can see a 5.4% increase in February 24, not too long ago, slightly higher than the inflationary target that we advocate of 4%. Over the last 5 years below that, and over the last 20 years sitting at 7% year on year. In comparison to Coca-Cola Consolidated, we see a 100% increase over the last full year. Over the last 5 years, double digits, although we do note over the last 20 years, it has been pretty much keeping up in line with inflation at that 4% level. Moving on to the payout ratios, then when we focus on the free cash flow below 70% for consumer staples, what we can see is Coca-Cola has been pretty much straddling higher than the 70% level. Last 2 years in the 80% region, and we see 2024 going higher at 86%. Not a massive red flag indicator, but definitely something to keep an eye on. The higher this goes, the more likely that those dividend increases will become smaller and smaller. When we do compare this to Coca-Cola Consolidated, we can see the free cash flow is very, very low, especially over the more recent period. In fact, 2022, 4%, 2023, 3% means that they have a lot of room to continually increase those dividends in the double digits that we do love to see as shareholders, as well as paying some very nice sums in the form of a special dividend. Moving on then to the free cash flow per share, we do note for that Coca-Cola, it has been pretty inconsistent, although it does move in the right direction over the longer term, and we can see FY24 at 2.24 expected, so not a massive amount of growth in comparison to what you may expect for other companies. Taking a look at Coca-Cola Consolidated, then we can see it has increased over the longer term, in fact very, very rapidly, 2023 around the $57 level as well, but again, do factor in, whilst there is inconsistency with COKE, they definitely increase their free cash flows at a larger rate and very quickly. But again, you need to note the inconsistency, and that could be a factor into your own investment thesis when comparing these two stocks. We then move on to essentially the sales growth increase, and as always, we look for 3 to 7% steady moderate growth. What we can note here for Coca-Cola is, in fact, over the last 10 years, the majority of those years have been negative growth to their top line. However, the last 3 years have looked a lot better, with 2 of them, in fact, being double-digit positive growth. When we compare that, what we can see here is, in fact, every single year over the last 10 years, positive growth. In fact, the last 2 of the 3 years are double-digit growth. 2023 looking very strong as well. And over the longer region, they do, in fact, get at a minimum that 3 to 7% level, which is always positive to see as an investor. So numerically speaking, for Coca-Cola, we can see their top line has in fact dropped all the way down to 33 billion in 2020, but then again has picked up. In fact, when you look at it, they did in fact generate a little bit less revenue in 2023 than what they did in 2014. And we can also note share buybacks is something they don't do that often. In fact, they have bought back a very small amount of shares over the last 10 years. but typically we love to see this reduce at a much faster rate, as that does indicate the company is returning excess cash to our shareholders. On the shares outstanding side, we do see a little bit of a similar story. It is essentially moved very marginally over the last 10 years. However, with Coca-Cola, what we noticed was that it reduced slightly. With Coca-Cola Consolidated, we note that it has increased slightly. Now, oppositely, when we look at the total sales, they have increased their top line at a very rapid rate, nearly 4 times over the last 10 years. So that is some tremendous growth for this company, especially if they manage to maintain it at the same pace. Moving on then to one of my favorite metrics, the return on invested capital. This does help us understand whether or not management are able to effectively allocate their capital. And what we can see, it has in fact increased for KO over the last 10 years. 17% over the last 2, so that is very strong. It has been above the minimums we want to see for consumer staples, and not just consistently but also growing over the period. A little bit more inconsistent for Coca-Cola Consolidated. Whilst it has increased over the longer term, we note realistically only over the last 4 years has it been fairly acceptable for us when analysing, but it has been increasing since then. If it does continue, that is very positive. FY23 around 34% as well, so we are looking at a much higher rate than Coca-Cola. However, to Coca-Cola's defence, they do have the consistency element that this company does lack. Then when we analyse the margins, Coca-Cola is looking strong on the operating side. We note the operational efficiency as it has increased over the period, as well as the fact it is above that 16% we want to see as a minimum for consumer staples. And on the free cash flow margin, consistently above 7% and very strong in the low 20s over the last 2 years. Now, one area that this company does lack, as we can clearly see, is their margins. Their operating side, again, it has increased from 2019. We do note around 12% in the more recent year, but it is something we would like to not just see higher, but also the consistency. And the same can be said for the free cash flow margin. We do note the 8% in the more recent period. Nonetheless, consistency does mean a lot to investors over the long term. Finally, we look at the net debt to EBITDA. Now, this is the earnings before interest, tax, depreciation, amortization. Remember, it correlates to both dividend safety and balance sheet strength. Consumer staples below 4, with these numbers indicating the number of years it would take the company to pay off all of their debt net of cash on hand. No worries with Coca-Cola. In fact, it has been downward trending since the highs of the COVID era at 3.03, 1.99 expected in 2024. Dividend looks safe. Balance sheet also looks healthy too. In comparison with Coca-Cola Consolidated, we see a much lower level, 0.12 2023. So very, very strong. As we did analyze as well the balance sheet very briefly, we did note that it did look very strong as well. So absolutely no worries. 1, with their dividend paying ability, and 2, with the strength of their balance sheet. So let's jump into the analysis on the stock valuation of these companies. The first one we can refresh is Coca-Cola. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically our deep dives, we do run through every single one of these models. Today's episode, we can jump straight into the intrinsic value. Now for Coca-Cola, it does come at just over $67. As always, we use that margin of safety of 10%, and we use that and execute if we believe it meets 3 criteria: the wide moat, strong financial metrics, and good forward-looking data. Now at 10%, it is a buy up to 60.60. Now at 15%, around $57. It isn't too far off that, but for today's episode, we see around a 10 to 15% MOS level. Do bear in mind as well, you can click on the pinned comment below if you do want to grab a copy of the valuation model to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or those on your watch list. In terms of Wall Street, well, they see around 20% upside of Coca-Cola with a price target of $70 over the next 12 months. In comparison, when we take a look at the valuation on Coca-Cola Consolidated, the intrinsic value similar to Coke is the average of these 3, coming to $1,000, or in fact just over $1,000. Now the current price is around $818, so we do take a look at that margin of safety. 10%, it does look to be a buy up to $907. When we go to 15%, up to $856. 20%, not quite there yet, but not too far off. So between a 15 to 20% margin of safety. So we do believe this is now trading with a healthier MOS level, around 15 to 20, as opposed to what we saw for Coca-Cola. In terms of the forecast, though, with Coke, we saw around 20% upside. With this, based on Wall Street's forecast, they do see around 12% over the next 12 months. Now, let me know your thoughts below whether or not this was interesting, if you'd like us to do this with other stocks, whether you took any education out of this. But as always, just because a company has essentially a higher yield, it doesn't necessarily make it the better option. Over the last 10 years, as we did see, Coca-Cola Consolidated did significantly outperform Coca-Cola, 991 to 97%. But again, different people will have different reasons for investing. Even if you are an income investor, they do also pay special dividends. It is definitely one to consider for the portfolio. Whether or not it is one you execute on, do let us know your thoughts in the comments below. As always, if you enjoyed the episode, smash that like button, hit that subscribe and bell button. And as always, we'll see you all on the next one.